Chakri Lokapriya joins us right now. He's a CIO and Managing Director at the TCG Advisory Group. They manage about $3 billion. Chakri, always a pleasure to speak to you.
Thank you.
The question that many of us have is the question of being skeptical whether the market rally will sustain. I was looking at some of the data coming in on flows to ETFs, and that's actually gone up to almost 10 billion in 9 weeks. Should we concentrate on the money flows, or should we concentrate on the dynamics at the moment?
I think that's a very interesting question. Money flows will follow corporate earnings and also the stability of the currency. And now both are turning positive from an Indian context. After several quarters of earnings decline, now we're beginning to see earnings trending to move up. And that's always a good sign for FIIs to come in. And second, with a current account deficit and trade deficits slowing down, improving, I think we will see a stability in the rupee, which again is another sign for FIIs to continue to invest into India.
Chakri, I'm going to break this up into two parts. One, the local dynamics of India and what's happening around global markets. So as far as local dynamics are concerned, we were looking at crude oil data, and India's consumption went up by 16%, not including even the reserves. This is just pure consumption.
Yeah.
Then we've seen data coming in on vacancy rates, some of them leading indicators of where the economy is headed. Do you believe with a lag time we could be heading into GDP growth rates of maybe even double digit, and that it's just not shown up as yet?
That is very feasible. Now, if you just sit back and look at a couple of important points, from the global financial crisis of 2008 to now, corporate earnings growth has been only about 5 or 6%. With a 5 or 6% earnings growth, your GDP has been actually growing at a much higher rate. Now, and therefore, it's very possible that after years of slowdown, corporate earnings will actually grow much faster. If you rewind back to the 2003-2008 timeframe, corporate profits grew 35–40%. So what I'm saying, forget about those kind of numbers. Even if corporate profits grow 20% in 2017 and 18, your GDP growth can be much higher. And so it's very conceivable that we are entering, as long as few things do not go wrong, into a long-term upturn in corporate profitability and therefore markets.
Sure. So we need to look at the markets once more. We're building into a perfect storm. And one of the reasons I've been saying this is because of the fact that the shorts are really helping the market. Mark Farber uses a term of the helicopter economy, that you put gasoline on a market, and short covering is actually putting gasoline on an already heated market. So what you're having is that anybody who's writing calls is getting taken out again and again, and they're not closing their positions. So if you're not going to close your positions, well, we're going to get trapped. And that's exactly what's happening. You've got about 230 points on the Sensex, 7976 on the Nifty, so 4 points away, and they're going to take out all the guys sitting with 8,000 calls. So, I mean, I'm baffled why the guys are writing the calls at this moment, because they've not succeeded since 7,400, 7,200. So, I don't know, at some point it's going to stop, and that short covering is going to give you that real bump up. So, Chakri, that brings me to my next question, is that, absolute return investors like markets that have unidirectional approaches, and we seem to be heading right there. I mean, we've done 1,500 points without a stop. Could we then start to see a flow of absolute return or hedge fund money? Of course, you manage FI money. Are you seeing that thought process coming in? Because once that happens, markets like Turkey or Oz or Taiwan or whatever start running into 200, 300% just on the index.
I think you've touched upon some very good points where you mentioned the perfect storm. And a perfect storm in this context is a positive perfect storm for Indian context, because it is a commodity-dependent country. Commodity prices are down.
Sure.
Corporate profitability has been low for several years, which is turning up. Inflation is headed down. Transmission of interest rates because of the RBI cuts is happening. RBI has done a phenomenally good job in prodding banks to clear up the NPMS. NPMS, mind you, is not just an Indian problem. Sure. It is an emerging markets problem worldwide. And I think the RBI has done a far better job. So when you take a confluence of all these factors, things are now beginning to turn up. And so there is no reason to doubt that this trend can continue, and this trend can be a sustainable trend up.
If we can go on to some of the sectors, Chakri, I mean, the public sector banks usually get beaten black and blue that they're not managing things well. But I'm looking at two parts. Of course, maybe they didn't manage things too well, but also the economy was just not in a state to pay them back. But what we are seeing with an improving market is that the pledged shares are worth more. Corporates can actually pledge more, and maybe their cash flows are improving so they can pay back more. Could that then make banks the play? And I'm not talking about the crowded trades like ICICI or HDFC, I mean the private sector banks, but the PSU banks as the play to the economy.
PSU banks, I think, are hugely undervalued. There are several banks which are trading at 0.4 times, 0.3 times book value. So that is doomsday scenario, which is unlikely to happen. Sure. Second, a turning tide lifts all boats. Sure. And so with a recovering economy, the NPA problem can come down. RBI steps will also do the same. And like you mentioned, with rising share prices, the pressure on banks because of the collaterals improve. And all these factors, given the valuation itself, are screaming buys here. At this point, we still have 2 or 3 quarters of NPA cleanup. Like they've given a 2017 deadline, March 2017 deadline for banks, which we will see this quarter and next quarter an increased NPA write-off. But I think the focus should not be on the write-offs, but rather than a return to credit growth, which is going to happen as banks see this greater confidence of rising stock prices as well as cleaner books.
Sure. I'm going to go into 2 sectors, one which has been the India play for a lot of institutional investors, and one which perhaps was getting there but didn't. So I'll start with pharmaceuticals. Whenever I speak to analysts and even people on the ground, there is a much higher trust, irrespective of the issues on the FDA, of Indian pharmaceutical products as compared to Chinese pharmaceutical products, especially on the intermediate level. And now you see a lot of Indian companies actually going into very expensive pharmaceutical markets like Japan. What do you think? Do you think there is more value on the pharmaceutical group of stocks? And I'm talking about the pharmaceutical equivalents of TCS and Wipros and Infosys. And could that become an India play and basically kind of expand their valuations?
Indian pharmaceutical companies have benefited on 2 or 3 fronts. One, a falling rupee has helped them. Second, the trend towards generic drugs has helped all the Indian pharmaceutical companies. Third is the Indian pharmaceutical companies have moved up the complexity chain. And as these 3 things have happened, the earnings growth, for instance, this quarter should be one of a very good quarter, barring 1 or 2 company-specific issues. So in the current context, I think healthcare budgets around the world, Japan, US, will increase, are increasing, and that bodes well for the Indian pharmaceutical sector. So it is one of the secular growth stories which is going to stay with us for a few more years.
Right. Chakri, for some of us who have been in the asset management side of the business, the challenge always is, what's my edge? I want to talk about some stocks where it's very difficult to find an edge because the trades have become so crowded. So let's say the 3 top IT companies, some of the big private banks where everybody plays India using them, and some of them are the most expensive technology or banking plays in the world. What do you do there? Because are they susceptible to a big crash on bad news, or do they really have much since everybody is already there? I'm just wondering, from an asset manager's perspective, how do you play the risk and how do you play the keeping the principal safe?
I think those are good questions in terms of because there's such crowded trades. In fact, 60% of all FII money is concentrated in about 50 or 60 stocks. And that's what I always keep emphasizing is that, hey, look, India is a country of 7,000 stocks. And okay, so there's a bigger world out there, very good quality companies, high growth companies. And I think that's what we focus on. We also look at the big boys, and so are these big IT companies and banks susceptible to a crash? No, because if you take SBI, for example, it's trading at only at very reasonable valuations. And if you look at Infosys or any one of those big cap IT companies, the multiples are pretty reasonable out there. So I think those stocks are well placed, but there's greater scope for the mid cap companies to grow much faster.
So, Chakri, you're one of the few funds that have the liberty to, actually fish around at the 7,000 pool, if I may.
Yeah.
Where are you finding that growth? Sectorally, where are you finding that growth? Where is it the market hasn't looked at it, and where is it that brokers haven't covered the stock?
I think a number of sectors, a number of sectors who have been the beneficiary of the commodity and oil price crash. Paint companies, chemicals, petrochemicals, auto ancillaries because of fall in steel prices. And petrochemicals has now expanded into the plastic sector. It's a really huge sector. Your tables, chairs, etc., auto components. And of course, IT and pharma have benefited from the rupee fall and the US strengths. I think in all these sectors, we're finding a lot of value, and we will see very strong earnings growth even in this current quarter. I think earnings growth should be north of a good 15% at a sector level.
So, Chakri, I'm going to break them into three groups.
Yeah.
One is everybody's conversational favorite is infrastructure. And I go and look in the portfolio, and it's filled up with financial services and consumer. There's no infrastructure. What's the issue? I mean, we talk about it, everybody says infrastructure is growing, but is it really being drilled down to stocks, or it is actually difficult to find good stocks, even though there's an infrastructure play?
In infra, I think the main problem has been that, except for cement, which is also an infra play, which is seeing a revival of demand, many of the stalled projects in the pure infrastructure play continue to remain stalled. The improvement has come only in the government-owned infrastructure companies who are beginning to execute on stalled projects. And so I think this is what is holding back a lot of the market participants in going full-fledged into private infrastructure companies.
Okay, we'll just take a quick look at the market, Chakri. And so basically, we've got pretty strong momentum. Bank stocks, we discussed them in the morning. They're the direct beneficiaries of all the great news, but also they are direct beneficiaries of what's happening on the provisioning side. So ICICI Bank 6%, PNB 6%, Allahabad Bank 5%, Bank of Baroda 4%, SBI 4.5%, Canara Bank 4.5%, Central Bank 4.5%. And 2 months ago, everybody thought they were coming to an end. So that's the kind. Union Bank, Andhra Bank, Bank of India, Oriental. Smita, whatever pace you use, it'll be difficult to put all these out because there are so many of those banks running up. Can you bring up that Equitas Holdings? There was a new listing today, right? Can we bring that one up? I think. Okay, so we'll take a look at that one. That one stock, but many of the stocks that was mentioned by Chakri, we're seeing a strong run. I'm going to come to paints and chemicals in just a moment, Chakri. Also, what's your view on metals? Because what's happening is metal stocks are running up. Is it just like is it just a rally that's trying to make up for such a large fall, or there's something different? And what's your thought on sugar? I mean, usually not an institutional play.
Sugar, I've generally stayed away from the sector given various regulatory issues that surround that sector. As far as metals are concerned, I think if they are still in an area of oversupply, if you take steel as a sector, there are 2.5 billion tons of capacity of steel worldwide, operating at about 67–68%, whereas demand for this year, 2016, will probably fall 7 to 10%. So in terms of volume and pricing, there's unlikely to be a sustained improvement. On the other hand, the seasonality stocking up that we've seen in China has revived prices, will continue to do so for some more time. And so from that perspective, yes. And Indian steel companies' prices, steel prices, have moved up about 3,000, 4,000 rupees per ton. Sure. So there's room for another maybe 1,000 or 2. So from that perspective, there is a trade, but is it going to be sustainable over the next couple of years? Not really, given that there is so much overcapacity or lack of demand right now.
You brought up some interesting stocks, most of them related to chemicals. So you mentioned chemicals, paints, petrochemicals. Is there something in the global petrochemical or chemical cycle, apart from the fact that these stocks rarely got covered, no brokerage almost looks at them, that could then basically double or triple them?
I think a confluence of factors have happened. One is many of these companies are petroleum derivatives, and with oil have fallen from 110 to 40 currently. Many of the input costs for these petrochemical companies have come down. Prices of their selling prices have not come down by the same magnitude. There has been a greater move in across all sectors. And I mean, you had container drums made of steel in the past.
Sure.
Now they're made out of plastic, various forms of plastic. Furniture, infrastructure items. Auto ancillaries are moving away from metal to using various forms of complex petrochemical derivative plastic products. So the number of sectors in which paints are users of this. And so as we see a greater consumerization, or your PET bottles, the cold drink bottles, water bottles, etc., are all moving, so the applications is improving. India as a country uses very little of petrochemical derivative products. End use is about 2 or 3 kgs per person versus 5-6 times that amount in developed markets. So I think the room for growth is huge. Brokerage coverage is minimal.
So another perfect storm.
Another perfect storm.
All right, Chakri, just one last thought from you. Going from this point, 1 year down the road, on stock picking, how much do you think one can make in these markets on an absolute basis? And just staying with the index, how much can one make in this market?
Just staying with the index itself is down about, over the last 1 year, about at 8-9%. Sure. So it's not an overheated market.
Absolutely.
And it's trading only at about 12 times FY18 of depressed earnings. So as with earnings in FY18 maybe about 18-20%, index level you can make about 15%, large cap. Sure. Mid cap, I think earnings growth will be far higher, returns will be far higher.